Welcome back to America's Commercial Real Estate Show. I'm Michael Ball. The segment's brought to you by BOMI.org. That's BOMI. They are the industry standard for training for facilities and property management. Check them out. Today we're talking about the office sector, the office market, and whether you're a tenant or a landlord, it's been an interesting market with the change in use that we're seeing in the office market. Well, please welcome my next guest, Steve Jellinek, and he's Vice President with Morningstar Credit Ratings. He's joining us on the phone. Steve, good to have you on the show again.
Hi, Michael. Thanks for having me.
Well, Steve, I think one of the things that's kind of curious to people right now is the government shutdown and what kind of risk that might bring to some landlords and some properties and some lenders with loans on these office properties. So if you've got GSA tenants, you've got federal tenants, might your rent just not come in?
Yeah, it's interesting case study, Michael. It's something that we really haven't seen before with the government shutdown or partial shutdown. So what we're seeing is, or what we expect is GSA tenants that have leases in properties, in and around Washington, D.C. and other parts of the country. They could be susceptible, those properties could be susceptible to the rent payments stopping should the GSA tenants be part of the shutdown. So it's hard to really say what ultimately may happen. I mean, obviously the landlords are going to get paid once the spigot turns back on. But in the meantime, if the rent checks stop coming, that would put the property owners on the hook for making their mortgage payments. So it's kind of anybody's guess, how long the shutdown's going to last, and which properties may be affected. And don't forget, it also comes down to how much of a particular property's rent roll is comprised of government tenants. If they're a smaller percentage, then obviously there should be less to worry about compared to if they make up, 30% or more of the rent roll. Then there might be some concerns down the road.
Yeah, that's true, and I guess also the size of the tenant, right? The creditworthiness. of the landlord, and the creditworthiness of the landlord. Can they make up the difference? And if you're listening to this show today, we're doing the show on January 9th. And so let me ask you this, Steve. One of the things that is kind of been a change in the office market is companies like WeWork, where you've got tenants who don't have, well, at least their tenants don't have a lot of commitments, and some of these leases with WeWork don't seem to have a lot of security to them in my mind. What kind of risk does that bring a lender or investor when they've got these types of tenants?
Yeah, I mean, obviously, WeWork could be a big risk. They're solidly the third largest driver of leasing activity nationally, or I should say co-working in general, whereas WeWork makes up the largest portion of that. We kind of tracked about 12.8 million square feet of co-working transactions in 2018. And so obviously, it's a decent chunk of the office market. Now, what the potential risk could be, obviously, and that hasn't been tested yet. In a down economy, what's going to happen if WeWork's tenants, move out? Most of them are on, month-to-month, quote-unquote leases. And should they move out, then, WeWork's deep pockets will certainly be tested. But that's kind of, we're looking into our crystal ball. It's hard to say exactly, what would happen, but it would depend on WeWork's deep pockets. One of the things that's interesting about WeWork is, obviously how much they've expanded. They just leased 64,000 square feet in Phoenix. They bought Lord & Taylor's flagship store in New York, and obviously most people, investors know that WeWork's the largest office tenant in New York City. But something that might also be working against WeWork is kind of the anti-decentralization of large technology firms such as Amazon and Google, Facebook. They rent or buy large office properties in major cities, and they are less likely to use co-working space. So that's it kind of comes down to, these companies believe that central offices are the place to go, and they believe that if they want to be in the markets with the best talent, then they need to be in some of the largest cities. Obviously, look at Seattle, how Seattle's become a big tech hub, and obviously the birth of the industry in Silicon Valley. So that's another downside to WeWork.
Yeah, and this pushed from a lot of tenants, and I guess in the market today, where tenants want flexibility and they want to be able to move or reduce sizes, and a lot of landlords are doing smaller spaces. They're getting spaces ready and giving tenants flexible leases. I recently sold a small building for around $3.5 million, and all the tenants were smaller, and they all had very short leases. A lot of them were just year to year. And then when we were financing that, a lot of lenders would look at it and go, "Oh, there's only 10% of the building leased over 3 years. I can't check that box." As that type of office environment continues to grow, Steve, how's that going to impact the security for these notes and for these properties that have all these short-term leases? As you said, we haven't had a big downturn with this type of tenant situation. How do you weigh it just on regular office buildings that don't have WeWork tenants?
Yeah, well, as leases shorten in their duration, that's something that the CMBS market is going to have to deal with. Right now, we don't see a whole lot of short-term leases, at least in the CMBS market, where we're dealing with larger loans. What we've seen is, a flight to quality, where, Class A properties are seeing more demand compared to Class B properties. But the risk is there with smaller tenants. It's something that if we do see an increase in the securitization of office properties with tenants with shorter term leases, that's something that we would have to. CMBS is usually really good at getting additional collateral for these types of arrangements, in terms of additional reserves, for instance, or guarantees from the borrower. Excuse me. So it's something worth noting in the securitization area, but not something that we've seen a huge growth of.
Okay. We're talking with Steve Jellinek with Morningstar Credit Ratings. And so, Steve, how do you guys and how does the market kind of look at the office sector moving forward? Does it look like a pretty safe sector?
So over the past year, kind of looking at the office sector nationally, we've seen it be pretty stable in terms of, there's always risks with vacancies, which have been edging up. Values overall have been stabilizing. And in a few markets, they've actually been falling a little bit, with rent growth in those markets flatlining, and absorption has been flat to negative in those markets. The better performing markets, obviously, are the ones that are are in tune with the attracting the large digital tenants, if you will, the large technology tenants, like San Jose. Some might even wouldn't probably recognize Huntsville, Alabama, or Ann Arbor, Michigan, as being among that group, but they actually are, and they're actually growing. Some of the riskier cities that we might take a look at are Hartford, Connecticut, and Indianapolis, as well as Kansas City. And one of the other things that we're really watching, industry-wide, is kind of the whole macroeconomic picture with interest rates rising, and that's kind of starting to weigh on borrowing, and the with the national cap rate, it's been pretty stable over the past few years, but with the Treasury rates rising, obviously means higher borrowing costs and less room for error. So, kind of with cap rates remaining stable, borrowing costs rising, we've seen some compressed margins. And up until probably a couple months ago, we've seen the additional competition from lenders kind of mitigate the rising interest rates. But lately, with the margins compressing to the point where they really haven't been since the crisis of about 10 years ago, what we're probably going to end up seeing is a pullback by lenders, which could signal, a drop in supply and a drop in supply of lending, that is, and potentially a drop in valuations as well. So, but nothing extreme. Just kind of, I think that the market kind of checking itself and maybe edging back down a little bit.
Okay. And Steve, if you looked at the large sectors of office, retail, multifamily, and industrial, how does office sector rank with those other sectors related to safety and interest from investors today?
Sure. Well, I mean, obviously, office is going to be one of the more risky sectors when in an economic environment that we're in now, with interest rates rising and companies potentially pulling back their hiring. The economic environment is where it stands right now is obviously the market is very healthy, but companies are going to be pulling back with since we're near full employment and interest rates rising, and they're going to be and wages are rising as well. So with the companies potentially hiring fewer employees, office compared to multifamily is going to be riskier. Multifamily we kind of see as kind of more stable and kind of a beneficiary of a rising rate environment. And retail, everybody kind of sees retail. A lot of people see retail as being the next or kind of being under an apocalypse, and we really don't see that. Even with Sears potentially folding, I believe they have another liquidation hearing or auction hearing next Monday. Even with Sears potentially folding, we don't see retail being as bad as most people predict. So, but in the scheme of things, office is going to be a little bit more risky as we move ahead in this economic cycle.
More so than retail?
I believe so.
That's interesting. Well, Steve, great information as usual. Thank you for joining us today.
Okay. Glad to be with you, Michael.
All right, well, stay with us. We'll have more on the office market. I'm Michael Bull. This is America's Commercial Real Estate Show.